All right, everyone, it is late Friday afternoon. I'm going to do one more teaching session today, and then I think I will log off for the rest of the day and relax just a little bit. So let me leave you with this before we head into the weekend. I want to talk to you today about Black-Scholes option pricing model. We're going to use Python to do all the coding and all the logic and all the plotting and charting and analysis and so on and so forth. Okay, so what is option pricing? It's actually a critical tool in the financial markets for both theoretical and practical reasons, some of which include valuation of options. That's what we're going to look at today. Hedging strategies, that's important. Is an option overpriced or underpriced? We're going to look at that. Options are very popular risk management tools. It's used for market efficiency, decision making for investors, regulation and reporting purposes, and scenario analysis. Okay, so I'm going to put a link to this URL that I found online. This is actually the Black-Scholes option pricing model. This is it right here. So this is a beast, right? This is kind of a behemoth when you look at it, but don't be too intimidated. We're going to get into the nuts and bolts and explain how a lot of this works. So it does look a little bit intimidating, but just sit tight and stick with me to the end, and I think you're going to learn a ton. So let's go over here. Let's look at Walmart. I just picked Walmart's for no particular reason, just picked it, right? So here you have a list of all the calls in the left-hand column and the contract name, right? So each one has a slightly different ID number, last trade date, strike price. That's where the option comes into the money or goes out of the money. If you're in the money, you're actually making profit. If you're out of the money, then you're not making a profit, okay? And last price traded, bid ask. The spread is the difference between these two. The market maker keeps that spread. That's how they make their money, right? And then you have the volume and the open interest. So this is number of contracts traded. So you can see right here, implied volatility is almost 400%. So the reason it's so high is because right now the market, if you look close, it's at 92.83. It's almost 93. So anything at the money is going to be a lot cheaper and have a lot less volatility. So right now the market is about right here. This 0.33 right here is the last price traded, right? And it's the difference. That's the historical volatility, not also known as, but there's two ways to calculate the volatility, the historical volatility or the implied volatility. We'll look at both in just a minute. But you can see how the implied volatility is much lower here. It's about 17%, and over here it's 400%. So if if Walmart stock drops from 93 to 65, if it drops almost 30 points there, like what is it, 28 points or whatever, then the implied volatility is 400%. You're going to make a lot of money, right? If you have this strike price, you're going to be in the money. So this guy would be deep in the money right here if the price drops. And this guy is at the money right here, right? So at the money, you don't see a lot of volatility. Deep in the money or deep out of the money, you see a lot. So down here, puts, if you, by a put, you want the stock to go down instead of up, right? So a put is sort of like a short, and a long is kind of like a call. And you can see the implied volatility right here because you're pretty far out of the money. It's 93 right now, and the strike price is 70. So that guy's way out of the money, okay? And this guy is that's way out of the money too, okay? At the money is right here. This is the 93. Oops, I'm sorry. That's 93. That's the current stock price. So you can see the volatility is the least right here. It's like 0%, literally no volatility, right? Because you're at the money. And over here you see at the money 93, but this is on the call side. And the volatility is pretty low, 11%. Not quite zero, but that is the lowest one, right? So that's kind of an overview of options right here. And there's two ways, like I said, to calculate the volatility. So we know 4 of the 5 inputs to the Black-Scholes model. We know this with certainty, okay? So there are 4 are current stock price. We know that's 93. The strike price, you know that is right here. It's whatever you pick for the option. You know the strike price is 93. That's the one you pick, but you can pick any of these, right? You can pick 65 through 93. 65 is going to be a lot more expensive, right? That's deep in the money right there. That guy is definitely making money, so it's a lot more expensive because he's guaranteed to make money. This is pretty cheap because it's at the money, but it's probably not going to really go into the money. The stock is 92.86. It's just in the money a little bit and expires today. If you look close, it's actually today at 3. This is the price at 3:22 p.m. The market will close at 4 p.m. So it's 3 6:54 right now. It's 6 minutes. The market's going to close, so nothing's really going to happen. See, at the end of the day, either you're in the money or out of the money. That's it. The money has been made. These stock options probably came up probably about 3 or 4 weeks ago. I'm guessing close to 4 weeks ago. So that's it. It's going to expire today in about 6 minutes, and nothing is really going to change that stock price too much at this point. So the current stock price is given, strike price is given. We just saw that time to maturity is given. We know that is today. It's basically 0 days or a fraction of 1 day, right? 6 minutes out of the market's open for about what 7.5 hours each day, and then the risk-free rate. So that is given too. We can go to the market, or we can create sort of our own risk-free rate. It would be about 3%, maybe 4% in this interest rate environment. The only unknown here is volatility, right? So what's the standard deviation? The standard deviation represents the expected annualized standard deviation of stock revenues. This is directly observable in the market. Okay, so these four are given: stock price, strike price, right? Time to maturity, and risk-free rate. This is the only unknown. So if we can calculate that with a high degree of accuracy, we can price these options very precisely, and then we can make some decent money with that. Okay, so let me go ahead and refresh this. Okay, and all we're doing is going to Yahoo Finance, importing data relative to that stock ticker, and we have the options change data that comes here, and we have all our puts and all our calls data right here. So this all comes to us free from Yahoo Finance. Let me refresh that. You see the available expiration dates, the contract symbol, and then the strikes. So we have 65, 70, 75, 25, 84, 20, 85, 15, 29. Okay, so if you go back here, 25, 84, 20, 85, 25, no, 15, 29, sorry, 15, 29, that's exactly what you see here. So you're just pulling in the data. You're not doing any analysis, you're just pulling this data from Yahoo Finance. So I think everything there looks fine. We have the four givens right here. This is the unknown. Once we can try to derive this volatility pretty accurately, we can make a very precise calculation for what that option should be worth, and then we decide is it overvalued or undervalued. Okay, so it's very interesting. I think I did a video about bond prices, which bond prices are overvalued, which are undervalued, stock prices, which are overvalued and undervalued, and now we're looking at derivative contracts, well, specifically options pricing, not really derivatives like a grain or cocoa or oil. This is more like options trading. I think I misspoke here. It is one type of derivative, I think, but derivatives are much broader than this. So there's two ways to deal with volatility, or to derive the implied volatility, right? So we have historical volatility and implied volatility. Okay, historical is a measure of how much a stock has fluctuated over a specific period in the past. So we're just looking at the standard deviation of prices and up and down, where's it going, back and forth, right? That is historical volatility. Implied volatility is more like the market price of an option using the Black-Scholes formula to solve for volatility. Okay, so we back into it, or we derive that volatility. Okay, so here is historical volatility right here. This is the first part of the equation. I put a little print symbol so we can separate historical from implied, and this is all the logic for the implied volatility. When we come down here, we'll see both are calculated. Historical is a little bit lower, 0.18. I'm sorry, in this case it's higher. I looked at one before, it was actually lower. So for Walmart, the historical volatility is a little bit higher. The implied volatility is a little bit lower, and that's fine. We have everything derived from this calculation right here, which originally came from this. Okay, so this was in fact invented by Black and Scholes, Burton Black-Scholes model, I think around 1956 or so they came up with this, and it's withstood the test of time for quite a while now. It's still probably the most popular way to price options, puts and calls in the market today. So we have the historical and implied volatility. So now we have 5 of the 5 that we need to solve this equation, right? So we have, this was given, remember, current stock price, strike price, that's a given, time to expiration or time to maturity, say basically the same thing. Thank you. Officially it's expiration, risk rate, and then volatility, and we have the historical and the implied, right? So now we have all 5. We can go ahead and solve our problem. So I am going to pull in a little bit more information from the Yahoo stock prices, Yahoo API endpoint. I want the current price, I want historical volatility, and a few other things, strike price and market price. Okay, so I'm going to hit refresh, and It's just Control Enter on the keyboard, and I'm going to give all this code to you guys when I post the video later today, so you'll have everything. You don't have to take notes. You don't have to try to write this down as I'm going. To sit back, relax, figure out what's going on in this file, run it for yourself. Okay, so because the option is expiring like literally in 1 minute, I have 3:59 on my clock here. So the dates to expiration is 0 and the time to expiration is 0, right? Strike price, we know it's 93. Historical volatility is 0.18. We got that from over here. Okay, and we know the risk-free rate is 0.03 and the current stock price is 0.9296, right? If we go there, so it's coming in right from there. So pretty nice. Everything is dynamic, updated in real time. Okay. Okay, so the next step here is to use the Black-Scholes model to calculate the theoretical fair value of an option, given the parameters that we discussed above, right? So the stock price, strike price, time to expiration, risk-free rate, and volatility. And we have all 5 now. Remember, originally we had 4, those are given to us, and we just derived the volatility. So we are going to plug that back into the Black-Scholes formula. And if you look carefully right here, you will see the same thing over here, represented probably just slightly different because of mathematical notations, but that's fine. So let's go ahead and calculate the price of the option, Control Enter to run it. Okay, we print the price of the option is 0.03, and the reason for that is because it just expired and it's basically useless. Like you can't even do the trade. It's 4 p.m. right now at the NYSE. And that's it. The market's closed. So it's basically almost zero value because there's no time value left, right? If you bought an option 2 weeks ago or 3 or 4 weeks ago, there'd be a lot of time until the expiration date, and anything could happen. The stock price could jump up, it could crash down. In either event, there's going to be a lot of volatility if there's a big movement, and that's going to make any kind of put and call more valuable and more volatile, right? So, like we saw before, if this is the strike price 0.93 and you have a strike price of 65, you made a ton of money. Look at the gain on this is 400%, right? Whatever money you put in, if you put in $100, you made 400. So what is that? You made like $400, right? That's all it is. If you put in 1,000, you made 1,000. If you put in 10,000, you made 40,000. So that's a good trade. If that was your strike price, if this is your strike price, you made like a couple of bucks, right? It's 11%. If I refresh this now, I think it's probably going to be 0, right? Because it's at the money and the market is closed. Yeah, okay, so almost. So I think it's just a timing thing, but basically the market's shut down now and you can't trade anymore. So it's almost 0% gain. And what was this again? 0.07 was the last price of the option, right? So it costs almost nothing, but you make nothing. This option costs $25, but you make 400% right there, right? So that's how that works. And this one is deep in the money for put, so kind of the same thing. Here, this one costs $14.65. Wait a second. Put. So yeah, and then all these are far outside of the money. So I'm trying to remember. I did this pricing before, but this was a few years ago. I just tried to refresh all the stuff in my model like 1 or 2 days ago. So anything that's further from the strike price, you're going to have a higher volatility, right, and higher movement. Anything right at the stock price, it's not going to move that much, right? It's just a small fraction of a percent there, right? So we got the calculated option price 0.035, and what did they say in here for this call? We go back to the calls, and at the strike is 0.07, so 7 cents to buy one contract. This says 0.35, so it's actually off about 3.5 cents. Not a big deal. It's off a small amount there, but it's only off three pennies basically, right? Okay, so pretty accurate. But some of these calculated volatilities or historical volatility and applied volatility might not match exactly what the market has, and the market might have more perfect information than the model does. There's a lot of traders that look at this all day long, and there's all kinds of economic scenarios, conditions related to geopolitics, supply of oil, anything from inflation to housing prices have an impact on all these things, right? Maybe housing prices to a lesser extent, but there's a lot of information that comes to the market. So this price right here is going to be pretty accurate. Overall, this is highly accurate too, but the other market price is probably slightly better approximation of the true price of that option. Okay, so um, continuing on, we choose the strike price closest to the current stock price that's at the money. That's what I said before. Okay, and there will probably be a small difference between the theoretical option price. That's what we derived above in this example in this code right here, and the calculated price using the Black-Scholes model. Okay, we saw that, and there's actually a small deviation in this over here too. But the point is not okay. You're off by 3 pennies. That's no big deal. The point is really to understand these other options here. This is in the money. This is in the money. This is the money. Anything lower has come into the money. Anything higher is out of the money because these are calls, right? It has to go up to 125 for this guy to pay off. It's not going to happen. Actually, that option expired 2 days ago, right? Today's 110. 2 days ago, this option expired, so that is basically worthless. It's trading for 2 pennies. I think something didn't refresh, but the point is to try to triangulate what you're getting from the Black-Scholes model, the implied volatility, the historical volatility, and then this price that you see in the market right here. Okay, so that is what we're trying to triangulate, like between 0.07 and 0.01. It's right at 0.093, so probably that is probably the most accurate price. Okay, some factors that explain these discrepancies, like we saw a 3-cent discrepancy. It could be market prices, real world supply and demand. That's what I just said. So anything economics, implied volatility, explains basically what the market expects in terms of future volatility. So the implied volatility and historical volatility can't explain future volatility, but the market can capture this, right? So the model is pretty sophisticated, but I mean, it has its limitations too, right? So the strike price and the expiration date at the time of the money or at the money ATM generally are closer to market prices. We saw that there's a time decay, right? The longer you have until the expiration date, the more chance the money, the more chance the option will move into the money, whether it's a put or a call. And Yahoo Finance prices reflect both intrinsic values and time value right here. Okay, so I think at this point, all these options have expired. This is last year. These have all expired over here. This one expired today. This one expired today too. Okay, so so these are gone. This is all useless. The smart money was made, and we can take a look at this Monday morning when the market reopens, and we'll have fresh prices here. Okay, so why would an option be over undervalued? There's higher implied volatility. Okay, we saw that the market will actually capture that volatility. The Black-Scholes model won't. It's trying to make that guess, but there's certain limitations and constraints too. Supply and demand imbalances. So the market is aware of that. The market prices are updating constantly. Okay, and you'll see this price updating all day long. That's just stopped because the market has just closed like 7 minutes ago. So as new information becomes available, it gets incorporated into the stock price, right? But the Black-Scholes model will not capture that. So you have market sentiment. That's how eager or excited or how stressed out traders are, or the overall market is, right? So you have human emotions and feelings that play into that stock price and real world constraints. So Black-Scholes doesn't count for factors like liquidity, transactions costs, or dividends, and it really only prices European options, which have to be held to maturity. American options can be not called away, can be sold at any time, right? So European options have to be held to maturity. American options can be sold at any time. So Black-Scholes won't really capture these nuances. It was never really designed for those types of special conditions for the option. So let us go ahead again and get the options data, and then display the head and the head of the calls and puts. So we started calls and puts 65, 70, 75, and down 80 is 11.16. We should see that exactly the same thing over here, 80, 11.16. Okay, so these are all the calls. And then on the put side, we'll see again 80.02 cents, and that is on the put side, 80 down here, 0.02 cents. So exactly the same. So we're not doing any math here. We're just pulling in the data. Okay, and then the next step, let me refresh this. This is going to show me the names of all the columns. The next step, I believe we are calculating the over and undervalued not conditions, over undervalued valuations for each of these call options. So what happened here? Column get low key implied volatility. Okay, so why would that be call implied volatility? Oh, that's interesting. So I think this changed because that was all one word before. That's why I printed the columns before. That's weird because I saw that the other day and that looked like it changed then, and then maybe it changed back. It's very bizarre. Okay, well, let's fix it. I can't explain why or how that happened, but well, that's fine. Let's fix it. Okay, so now we have, whoops, now we have another error. Strike. Okay, so this is bizarre because I saw this change the other day. They are saying strike has a capital S, and over here, let me look for it. Strike. Very bizarre because I know I saw this. I changed it just before I started the video here because I saw an error before. I was testing things before I turned on the recorder. Okay, so that fixed it. No, it didn't. Oh, last price. Okay. It's always one more. Okay, let me look for the last price. LASTPRISD. Okay, so these spelling conventions or the naming conventions changed. A little bit concerning. But whatever. Let's just deal with it. That is price implied volatility. Also, this one's gonna change too. Okay, so let me fix this. Sorry guys. So I don't know why they would change the column names midstream like that, but it's fine. We'll fix it up. But it makes me wonder, like the next time I run this, is the column naming convention going to be the same, or is it going to change again? It shouldn't, but I mean, I guess we could write some logic and say that should be straight right there, implied. I think that'll work. Oh, okay. So we got the no. There's another one. Last price. There's always one more, huh? It's a little bit annoying. I don't know what's happening here because I literally changed it right before I turn on the video recorder here. Okay, it seems like it's working. But why would it change like that? I have no idea. I can't explain that. Okay. Let me just go down here and test this because now I'm a little bit afraid that something else is going to change. You can test it and say, is this, if it's not this name, then use a different name. So did it again, right? So implied volatility. Okay, we'll fix it. Playing some games here. That's fine. And then that is implied capital, right? Oh, wait, let's see, implied volatility. And last price is another one. Strike. Oh yeah, strike. Okay, we'll get it. Oh yeah. And then I think that's it. Let's see. Run it. We'll see for sure. There we got it. Okay, and then here's the plot. And okay, everything converged at the end there. So the plot looks a little bit weird. Typically, it would be horizontal to the left as you go into the money. These stocks over here are, it says overvalued, undervalued. Probably not the best time to do this demo because we're late in the day and the market just closed and all of these options just expired over here. So the last one that we had was 110, 2025. But you know what? I'm not going to redo this video. I think 95% of this is fine. Normally, if you look at this Monday morning or anytime just before the stocks expire, the options expire, then you'll see a more realistic move from the left up to the right for calls, right? This is going into the money as it's going higher and higher. The market price is higher and higher. It's $25. And these down here are almost useless because they're out of the money or they're at the money, okay? So let me see if I can see one more thing over here. Let's see, option price plots. Let me try this. Just to show you basically what these things look like visually. Oh, here's one. Okay, this is fine. So anything that goes into the money is going up in value, or puts are going to go down in value. So can I get that? Is it going to let me do this? Okay, so call option Payoff, so anything that is positive. This is a call buy payoff, and this is a call put payoff, so it's going down, but it's still positive because you want the stock to go down. This is going up in money, in value, right? Call option buy payoff, put option sell payoff. Okay, so as the stock goes lower and lower, um, as the stock price goes lower and lower, you lose money because you sold it. If you sell a call, you want the call to go down, but you're making money. If you buy a put, you want the money to go up. So anytime you buy, you want to go up. Okay, so up to the left in the lower southeast quadrant, up to the right in the northwest quadrant here. Okay, if you buy something, you want to go up. If you sell something, you want to go down. That's what you see. The put sell, it's going down in value. You can buy it. You don't buy a lower value. I'm sorry, that's like a short. You would actually just make money as the stock price goes lower and lower. As the stock price goes higher and higher, if you sell a put, it gets a little confusing. You might have to like read the definition and study some terminology. But if you buy a call, you want to go up. Buy a put, you want to go up. If you sell, you want to go down. So this on the northeast quadrant is going down. You're making money, and selling a call is going down. It's making money. So that's what those look like. I will go ahead and put that into the notes over here. So that's pretty important too. And I'll just add that right there. Okay, I'll share the notes with everybody later today. Let me close this. I don't need to find anything. So where are we? Almost at the end here. Okay, so we got the chart, and we have the profits and losses over here, and there's the last chart. So the last thing I want to show you here is all the implied market price, the theoretical price, and market price and strike price, and then we're going to go do a quick calculation to determine is the stock option overpriced or underpriced, overvalued or undervalued. Sorry, I misspoke again. So we have the strike price, market price, theoretical price, overvalued. The market price is 1. This is less, so these are overvalued. We wouldn't buy any of these. This is actually undervalued right here. The market price is 95. It's worth $1.02. The market here is asking $2. This is worth $2.02. So these two you could buy and make a profit on. And over here on the put side, these are the calls at the top. On the put side, you can tell right here if you look at this. Oh, I'm sorry, these are all puts. I'm sorry, these are all puts. So the calls are above this. The calls are over here. Okay, data frame calls. This is what it looks like. And over here, we can see the same thing. So market price, 0. Theoretical price is 0 because it just basically expired. So all of these look a little funky, but they're all overvalued right here because that those options just expired today. And then down here, you would see the opposite on the put side. These are all the put head and tail results, and you can see these two you could buy and make money on. The theoretical value is 95 cents. The actual value is 1.02, or calculated value. This is selling for $2. The value is actually $2.02. So anything that says false over here, this is selling for 95 cents. It's worth $1.02. This is selling for 2. It's worth 2.02. And same thing here. You can buy this for $2.96. It's worth 3.02. Okay. All the others that say true, these are overvalued. You wouldn't touch it. Okay. Doesn't make any sense to buy those. You're probably going to lose money. But then again, this is how these things work, right? This is mechanics, but it's a little bit theoretical. You could buy something that's overvalued and still make money, but it probably won't happen, right? So we have to be careful of that. So in conclusion here, the Black-Scholes model provides a lot of important benefits for options pricing, closed form solution, widely accepted benchmarks, risk management tools, simplicity and speed, optimal for European options, not for American options, only for European options, market consistency, and theoretical framework for options pricing. So it's tried and true and tested. I think invented in 1956, and it's been around ever since then. It's withstood the test of time. So that's it, guys. Take a look. Hopefully you can learn a couple new things today. Go ahead and experiment with this theory if you want. I've made some money in the stock market. Trading options, I lost some money too, so you have to be careful with it. Just start small, build your confidence, get mature with this stuff, and I think you can have a lot of fun and make some decent returns too. Okay, there you go. I'm going to wind it up now. Friday evening, heading into the weekend. Enjoy your weekend. Enjoy your time off, everybody. Bye.